long-term solvency ratios are also called as capital strength. Group of ratios are long-term solvency ratios. These ratios are also called as capital structure ratios, also called as leverage ratios. So capital structure is the main determinant of the long-term financial condition of a business. We all know that an insolvent person is one whose assets are less than his liabilities. So whether the firm is able to repay its liabilities over a long period of time, such financial position will be revealed by long-term solvency ratios. The important long-term solvency ratios are the debt-equity ratio. Debt-equity ratio measures the relationship between the long-term debt of an organization as is equity. So long-term debt refers to debentures, long-term loans borrowed from financial institutions, bonds borrowed from the public, and equity shareholders' funds. Equity shareholders' funds comprises of equity share capital, preference share capital, reserves and surplus, minus any fictitious assets. So the debt-equity ratio is the most important long-term solvency ratio, and the ideal debt-equity ratio is supposed to be 2:1. At any point of time, a company can have 2 times its equity as debt. The second important long-term solvency ratio is the capital gearing ratio. Another ratio is the capital gearing ratio. The capital gearing ratio refers to relationship between equity shareholders' funds and fixed interest-bearing securities and dividend-bearing shares. So this ratio will help in diagnosing whether the company is highly geared or lowly geared. Then we have a very common ratio called as the solvency ratio. The solvency ratio measures the ability of the firm to pay its long-term loans. It simply refers to the relationship between total assets and total liabilities. So these are the important long-term solvency ratios. Third group of ratios are profitability ratios. This is a very simple concept. Profitability ratios measure the profit earning capacity of the business. There are 2 sets of ratios under this. The first is profitability ratios related to sales. In this category, we have the gross profit ratio, we have the net profit ratio, operating ratio, operating profit ratio, expenses ratio. Then we have the profitability ratio relating to investments. Investments refer to the amount of investment made by the long-term capital providers, that is equity shareholders and long-term debt providers. So these ratios include ROI, return on investment ratio, ROCE, return on capital employed ratio. So these are the profitability ratios. And the last category are the activity ratios. The fourth category